Another blowout jobs report, dollar rallies, stocks actually go down. What do we make of all this? Well, that's why we're going to bring in Jim Welsh of Macro Tides to break it all down with us. Jim, I mean, great jobs number. Stocks didn't really like it, but maybe that's because the yields are ripping right now. I mean, what do you make of all this move that we're seeing?
Well, it's understandable, given the decent number in terms of job creation. The unemployment rate ticked down to 4.1%. Average hourly earnings were okay in terms of not, they were tame, so to speak. But I think it's twofold. Obviously, the absolute level of Treasury yields and diminished prospects that the Fed will be able to ease rates. And Bank of America came out this morning and said, no, they're not going to be able to cut rates anytime this year. It's a bold forecast. I think it'll be proven wrong. But in the short term, the data and what's happening with yields and the dollar are having an impact.
Yeah, I mean, the dollars rallied, yields are just screaming higher. And how does the Fed control this? I mean, with yields going higher, it's got to hurt lending, credit card lending,
Yep.
all sorts of small businesses. I mean,
Yep.
what's the Fed going to do at this point? Do they just continue to lower rates? What do they do?
No. Well, in the short term, they can't lower rates. The data has gone against them. We're going to talk about the CPI in a few minutes. And what I wrote a few weeks ago was the CPI for December, when it comes out on January 15th, next Wednesday, is not going to show improvement. If it is, it'll be maybe a tenth on one of the index, either the headline or the core. But the real improvement starts over the next 4 months. January through April, you have 140 basis points coming off the CPI from January through April of 2024. In the PCE, it's around 130 basis points. So the point being is if you subtract 140 basis points over the next 4 months, and you add 25, which is about where the CPI and core have been running, that means the headline and core inflation will drop by at least 0.4%. And as we've talked, shelter inflation is going to diminish gradually over the next 4 months. So, in other words, those measures could drop by even more. And the same thing applies to the PCE. So the point being is the Fed is in this rock and hard place where they really can't do anything until the data opens the door for them to even consider lowering rates because they would look foolish at this point in time. So I think all this stuff is coming together. And again, if I'm right about the inflation data that we'll start to see mid-February and on, I think that's when the markets will get some relief in terms of, oh, wait a second, maybe our inflation concerns are overblown. The wild card continues to be how much inflation will come from tariffs. I think that's overstated, but right now, nobody knows. The inflation from wages, if the thought that, well, Trump's going to deport 10 million people. Well, if he does that, you're going to have economic disruptions, and you will have wage inflation. I don't think that's what's coming. But right now, again, that doesn't matter because I don't know for certain and no one else does either. So you need clarity. And I think that's one of the things that the Fed has emphasized in listening to some of the speeches in the last handful of days. It's like we think inflation may be coming down, but there's these known unknowns that are going to drive the bus for a while.
Right. And so the point is, I guess, as President Trump is inaugurated, what kind of sweeping tariffs is he going to implement that's
Yeah.
really going to have an effect on us?
Well, there's going to be headlines, Blake. Well, we're starting here in terms of 10%, 20, whatever the number is. And then the negotiations begin. And, the point I've been made, there's a lot of uncertainty about this all the way around. And it's legit. I mean, the idea that Trump was going, the economy's in good shape and he's going to make it better, to me just seemed overly optimistic because the trade negotiations are going to be challenging. These other countries that we're going to negotiate with will need to get something from Trump that they can sell to their people. I didn't cave into Trump I fought for us, and this is what we got. And I think the headline number of where the tariffs start at, Blake, it's going to probably come down by half. And imports are about 12% of GDP. So we're really talking, I think, about a modest one-time bump potentially to inflation of 2 to 0.2 to 0.4%. And it could be closer to zero point 0.2. Well, if that's the case, then obviously the concerns about tariff inflation are overblown. So again, it's negotiating points, but until the dust settles, right now people are assuming the worst.
Yeah, and they've got to. Okay, well let's go into some of your
Yeah,
charts that you brought because we gotta get through these. And
yep,
I know you want to really focus on inflation, so
right.
let's get into it. And the first chart you brought here
Well,
is regarding the PCE.
yeah. Well, this is the minutes of the Federal Reserve, and how many times words were mentioned in terms of people worrying about inflation, and what we can see is that huge spike in 21 and 22, or I should say 22. And then we saw this less concern, less concern. And we talked about this, I think, last week or a couple of weeks ago when I showed the summary of economic projections and how they had jumped significantly. And part of that's being driven by FOMC members assuming we're going to get inflation from tariffs and potential wage inflation from deportations. And this is just another way of capturing that. You can see that's a huge jump from September to December.
Sure is.
And that's what, again, people are reacting to this. The minutes came out on Wednesday, and it really wasn't new news, but it just may be reinforcing, uh, what was apparent in the SEP that came out after the meeting. So again, inflation is the boogeyman, and right now people are thinking he's climbing through the window.
Okay. The next chart you brought, and I like that analogy, by the way, is 10-year break evens. And
Yeah.
so explain to us what we're looking at here.
Well, basically, this is another reflection of inflation expectations, and you can see how, a few months ago, after we got some good inflation data, the bond market was rallying, and you can see back in September is when bond prices hit their high, Treasury yields hit their low,
Yeah.
inflation expectations based on the 10-year break even were really, really very low. And now what we've seen is a big increase. We're back to about where we were in April when Treasury yields ticked higher. Treasury yields now have exceeded that high. So term premium is nothing more than, okay, if I'm going to hold this 10-year bond, I need some premium for the unknown risks in terms of inflation, monetary policy, and so forth. So this is, again, just another way of viewing how people have become very quickly afraid about inflation. And we're at, I think, an important level in terms of the break-even rates kind of holding steady. I think there was I think a consumer confidence report that came out today too, Blake,
Yes.
in inflation expectations within that jumped a fair amount. I haven't looked at the details, but I heard Rick Santelli on CNBC talk about like, whoa, wow, look at this 1 year inflation expectations. The Fed pays attention to this. So right now you have fears and some, better economic data or good data, and then these expressions of people worrying about it all coming together. And I think that's why we're seeing Treasury yields exceed the April high.
All right. Well, and yeah, people are buying things now in anticipation of, right? So,
Right,
yeah.
right. And they're making decisions, if you will, based on that. Okay. This is the term premium. Pardon me. This is the chart that really shows the risk of holding treasuries. Back in March of 2020, when the 10-year was at 55 basis points, what we can see is in October of last year, it got up to about 50 basis points when treasury yields peaked. Now the term premiums exceeded that. So this whole idea of people really being worried about inflation is expressing itself in all these different indicators. And until we see the inflation data start to improve and more data, obviously, and information regarding the tariffs policy and so forth, we're not going to see a meaningful reversal. I think that's coming, but in the near term, this is what's driving the Treasury market.
Okay, and it is obviously flying, and
Yeah.
yields are reciprocating, right?
Yes.
Okay.
Yeah. Yeah.
All
I
right.
mean,
So the
at this
next
point in time, one
this
last thing, I mean, in terms of any market,
yeah,
when the information is kind of lopsided, whether it be bullish or bearish, what it means you have a dearth of the other side of the equation. So right now, you don't have a whole lot of people buying treasury bonds because the information seems lopsided, from every single aspect. And obviously you get disproportionate moves. The opposite happened in terms of the tech stocks, where, oh, you got to own them. Well, if everyone believes the story about artificial intelligence, there's not much selling pressure that shows up. So anyway, it's just the dynamics of the market. Okay. This is the term premium again.
well, this is
Okay.
this is the chart that I flipped to the next chart, but this is the was your
Oh,
next
and
chart.
I threw you a curveball. Sorry. Okay, so this shows FOMC members talking about how restrictive the funds rate is. And what we can see is when they decided to stop raising rates in July of 23, that was basically the high of people, hey, we're really restrictive. And we can see how it's come down. And Powell talked about this. Well, we've lowered the funds rate 100 basis points, so we're a lot closer to the neutral rate. And this is all relative to the neutral rate. And so the meaning for this is uh, they're going to need the cover of better inflation data and probably some slowing in the economy, in addition to some clarity regarding the other issues. But if we see the inflation data improve, as I think it will, that'll help. But right now, what this tells us, Blake, is there's no rush inside the FOMC to cut rates. I mean, it's stating the obvious at this point in time.
Right.
And we've talked about that over the last few weeks anyway. But this is just another way of illustrating where the mindset is within the FOMC.
Gotcha. This is your chart that you wanted to explain what we're
Yeah.
looking for moving forward with CPI.
Yeah. So first we have to get through the hurdle of the December report. And the very top line, you can see the December of 23 number is 23 basis points, 28 basis points for the core. So recently, you can see in the last 2, 3 months, both those numbers have been hovering around 25 basis points and 30 basis points for the core. So all I'm just saying is, okay, if they come in like they have come in the last 2 months for December of 24, you're not going to see the CPI probably downtick from 2.7 on the headline or 3.3 on the core. Well, this is like throwing a little gasoline. Oh my God, we're not going to have, there's still not, oh my, I mean, it's like the negativity is pretty high and this isn't going to relieve it. The point we talked earlier is if you look for January of 24, February, March, and April, the numbers I have highlighted in red, headline takeaway values 140 basis points, 144 for headline, 140 for core. Well, if you average 25 basis points in those 4 months, this is where the math comes in, where, hey, by the time we get the April inflation number in mid-May, we could see the CPI, the headline down around 2.3, and the core would be down probably 2.7, 2.8-ish, maybe a bit more if the shelter stuff starts to filter through as it's starting to the last couple months. So, but this is the data that the Fed needs itself. They also need market participants to see this because it'll renew confidence that inflation is not going to zoom up again. It's going to start to ease.
Yeah.
So,
But this month, the what you're saying though is next week on the 15th, the data will still look pretty hot.
yeah, it's not going to show any relief. It's going to be like treading water and no progress. Well, that just feeds into all the fears that we've just been discussing the last few minutes.
Right, right. Okay. All right, Jim. Well, let's get into some of the markets. The dollar, this wave five
Yeah,
that you've been looking at. I
yeah,
mean, it's
yeah.
we hit a new
Uh,
high. So
yeah,
what's going on here?
I felt, somewhat convinced last week that, hey, that spike up to 109.54 was it. And obviously, it wasn't it. You got a spike up to 109.96. The CPI data could inflame it, if you will, more. Bottom line for me is that when the reversal comes in the dollar index, reversal lower, I think we're going to see a big move to the downside. But in the short term, given where everything is, one has to obviously respect. To me, it's been too early to short the dollar. It's like, okay, we're at levels that we should see a reversal. It hasn't happened yet. And again, simple momentum analysis, that 5 and 13-day exponential, the red and green line on the dollar, you can see is, hey, it's still positive. So when I talk about the reversal, that's what I want. One of the things I want to see is, yeah, you get a pullback, but it's deep enough that the red line crosses below the green line. And, that'll provide much more confirmation. Up until now, it's like, okay, I'm trying to top tick the dollar. But there's no justification yet to conclude that the trend is turned around. I really thought the probabilities were high last week, and you can see we had a little pullback, but again, the data came in to be supportive. The CPI could be supportive more next
Oh,
week.
all right. And so that's it. I mean, if the dollar index breaks above 110, it's off to the races, which could
Well, I
very
know
well
about
happen.
off
I
to the
mean, especially
races. It's
with
just that, hey, the trend's up. I mean,
yeah.
could it go back up to 114 then? That opens the door to that. That was the high, 114.70 something in October of 22. So that's the risk.
Yeah. All right. Well, the next chart you brought is going to be gold. Gold actually has moved higher.
Yeah.
So what do you think here?
It hasn't done anything to, I think, invalidate the expectation that sooner or later gold's going below 25.41. So even if we take out that red trend line, I'm not convinced that that means gold is on its way to 3,000. I still think we have a deeper pullback coming. Because of time, wave two. This is wave four from the low in September of what, 22 in gold. And that lasted 4 months. Wave two did. I think time suggests this has longer to go. The other thing is positioning. The positioning that led me to conclude in October that we were nearing a high is still hasn't been relieved. In other words, as gold has been chopping around, people stayed bullish. Normally, if you're looking for the next leg higher, we would see a retracement in terms of the level of bullishness and positioning. It hasn't happened. So I still think, as I said, I think gold is going to ultimately go below 25.41 before the next leg higher takes hold.
Okay. Well, the next chart is going to be TLT. You've been looking for a bottom, um, and it still looks pretty bearish.
Yeah. Well, again, once we took out that red trend line, it's like, okay, we got to be neutral here. My bias has been looking for a low. Again, the 5 and 13 exponential averages, the red and green lines, they haven't flipped positive during this whole decline. The key level is the 82.42 back from October of last year. The pattern that I'm showing here is, and we've been talking about this for a while, is that Treasury yields are going to have another large decline, and that ultimately TLT will get above 101.64. I've been, well, it hasn't happened yet. I have, I've been kind of on the sidelines once we took out that red trend line, but my expectation is the same. But in the near term, everything is working against Treasury yields as far as there being a reversal in yields turning down. So right now, to me, it's just, again, wait, stand aside. It's very oversold. So for me, being short here doesn't make sense. At some point in time, even if I wanted to be bearish, and that's certainly possible given what's happening, I would expect TLT to rally back to the underside of that red trend line. That'd be, classic technical analysis. Break a trend line, follow through to the downside, and then pop back up to kind of retest that before heading lower again. So far,
It
I've
sounds
been
like you're
wrong in
more.
terms of
It
looking
sounds
for a
like you're
low because a low hasn't happened.
okay. So it sounds like you're more in the camp now that because before you thought TLT would rally and break all the resistance levels that you're looking at there,
Yeah,
but it sounds like you're much less constructive nowadays.
I would say I still expect that, but obviously there's been nothing to prove that that indeed is happening. So one
Yeah,
has to just look at, hey, what's being dealt here? Well, what's being dealt here is more and more selling. And as I said, the CPI number I may not provide much help. All the other charts that we showed are showing that people are, whoa, I'm worried about inflation now. So
right.
until you get better data, Blake, you got to respect the sell-off that's been happening because the amount of selling pressure has been very consistent and very dynamic.
Sure.
So, yeah,
Okay. Respect the price action. All right. Well, speaking of which, you've been looking for the S&P to kind of roll over here, and it looks like it's doing it.
trying. Yeah. Yeah, underlying breadth has not been good. I think I've shown the advanced decline line. I've certainly written about it over the last few weeks that even as the S&P was holding up since mid no or end of November, the AD line has been very weak. That's usually a precursor to a decline of 10%. And back in mid-December, it's when, hey, I think we're setting up for a correction. And already we've seen the S&P equal weight down 7.7% and the Russell down 11. And the Russell just made a lower low today. I think the equal weight's close to it. Again, I think a flush job is, I think, one of the comments that I made last week. To me, it is setting up, but I don't know that we're about to go into a bear market. Let me put it
Uh,
that way.
Okay.
I
Well,
just
you
think we got a
so
flush job, and then we see what happens. If I'm right about inflation providing some comfort
yeah.
as we get into mid-February and beyond, that we could see everything shift pretty dramatically. We were like, whoa, wait a second. 3, 4 months from now, well, maybe the Fed will have the cover to cut rates. You know, and so I think the pendulum has the potential of swinging the other way.
Well,
But
it's
the
definitely
negative, the
swung.
market,
It's swung it's still swinging the other direction. You got a lot of banks that are saying, hey, there's not going to be any cuts this year, and just when they say that there's going to be no cuts is probably when the economy is going to turn south.
well, think about it. A year ago, everyone was looking for 6 cuts in 2024. Remember, that was the rage. All
Yeah.
right. That proved to be dramatically wrong. And I think your observation in terms of, okay, now the banks are telling everybody no rate cuts. Well, again, inflation relief is right around the corner at a point in time where heightened fear and concern about inflation is, to me, reaching somewhat of a crescendo. But, I don't think the CPI next week is going to show and provide much relief. So, you know, treading water, I don't think is going to, oh, okay, now we don't have to worry about inflation. They're going to have to actually see those numbers improve.
Yeah.
And I think that's at least a month away
All
for the
right.
first
Well,
dose of it.
let's a month away, no relief, and let's see how the market's traded. I mean,
Yeah.
we might continue to see the dollar rally, and hell, I mean, maybe even stocks are going to lose, some really key levels of support, especially as yields continue to climb.
Yeah. 5,700, I think, is a very important number. That was kind of right around that area, the last meaningful trading low. So can we test it? Yeah. Again, the breadth has been very weak. And the irony is that most of the stocks have been weak over the last month. They're cyclical stocks. At the same time, when people are saying, yeah, the economy's good and Trump's going to make it better, then why the pronounced weakness in so many cyclical sectors? Like it doesn't add up. And
Yeah.
I think we're starting to see that disconnect manifest.
All right. Well, Jim, it's always great to meet with you on Fridays and keeping us up to speed with everything that's happening. Next week's going to be another hell of a week. What's the best way for traders to get a hold of your work?
Macrotides.com or send me an email, Jim Welsh Macro at Gmail.
All right, Jim. Well, it has been a pleasure as always. I look forward to catching up with you next week, and I hope you're staying clear of those wildfires that are north of you.
Yeah, thankfully, they're about 100 miles north of us. We have some winds, but so far, no fires. It's just extraordinary to see, obviously, as we're all looking at what's happened.
The
All you
shame.
can do is have empathy for those people because their journey is just beginning in terms of, putting their lives back together.
Yeah,
So,
we thoughts and prayers to everybody that's dealing with that up in northern Los Angeles, I guess it would be.
yeah,
All right, and everybody stay safe out there. Jim, we'll catch you next week.
you got it, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.